It's that time of the year where everyone is rushing to get their last money into their retirement annuity to get a tax deduction. But is this actually a good investment? As always, let's look at some numbers. Generally, I'm not a big fan of contributing to pension funds or retirement annuities. Reason being, despite the very lucrative tax advantages, they're quite restrictive around what you're allowed to invest in. And especially for young professionals, if you've got a lifetime ahead of you to take some risk in the stock market, then you want to be doing that to get maximum growth. Let's assume your annual taxable income is $850,000. This is relevant because we want to see in which tax bracket you fall. In this case, your highest marginal tax bracket would be 39%. Now, let's say there are two options. On the one side, you can take 36,000 Rand and put that into your tax-free savings account because that's your annual limit. On the other side, you can contribute to your RA and get a tax deduction. And in order to compare these two, you can contribute 59,000 Rand to your RA and get a 23,000 Rand tax deduction. So your net cash flow result would be 36,000 Rand on both options. On the tax-free savings account, you're investing post-tax money. And on the RA, you're investing pre-tax money. So on the RA option, because this is pre-tax money, you can invest much more. But what does this look like in the long term at the different growth rates of these investments? The RA fund has to be Regulation 28 compliant, which means there are restrictions on how much foreign equity exposure you can get and how much total equity exposure you can get. And if we use this fund as an example, we'll use a 10-year average return because in 2011, Reg 28 limitations became applicable on an individual investor level. So in my opinion, this makes the returns pre-2011 almost irrelevant. So the 10-year return is 8.7%. Let's forecast it at a 9% annualized average. On the tax-free savings account, you don't have any restrictions on how much foreign equity exposure you can get. So that could be fully invested in an S&P 500 ETF, for example, on which the average returns over the last 8 years has been 17.1% annually. But let's use a forecast of 16%. Of course, historic returns don't guarantee future returns. This is really just to make assumptions. What's the result? On the retirement annuity side, you were able to invest much more. 59,000 to be exact, where in the tax-free savings account, you could only invest 36,000. But if we forecast this at the different assumed growth rates, you will see by year 8, the tax-free savings account exceeds the retirement annuity because of the superior return. And if we extrapolate this and assume the returns continue over a 30-year period, we could be looking at a 2 million Rand difference, with the tax-free savings account investment by far being superior to the retirement annuity. And also, the tax-free savings account is protected from any tax, where the retirement annuity does have some favorable tax rates. Above a certain level, it becomes taxable. And on the tax-free savings account, there will be no capital gains tax. So please don't just assume that the retirement annuity is the superior investment because of the tax advantages it gives you. I've prepared a free resource for you to learn more about tax-free savings accounts. Comment free and I'll share the link with you.